If this gets managed and actually the pipeline, gets reopened in the next couple of days, is it going to be short-lived, or are there going to be longer-term repercussions?
Well, the market's pricing as if it's a very transient, short-lived event, which is why the market response is relatively benign. I think that, first and foremost, this was an attack on the software, not on the hardware, which tells you that the time to fix it is trivial. Until they're comfortable to restart the system. But more importantly, the Department of Transportation has lifted any restrictions around trucking and boat transportation, which means that you can use other avenues of transportation to deal with this. And then finally, if you had to resort to pulling supplies out of Europe, you're talking 7 to 14 days. So there's ways to get around this. And I think the big one is that, the Department of Transportation has lifted any restrictions around trucking and marine shipping.
Jeffrey, overall, how do you see recovery in demand going? Because that will, of course, determine also how acute this is.
When we look at all of these markets, there are three big dynamics that have shifted in the last, let's say, call it, 3 to 4 weeks. Because if you recall, commodities were stuck in this consolidation period from mid-March through about mid-April. And driving that was a macro tailwind driven by higher rates. You had the seasonal shoulder months, meaning demand comes down and then it comes back up. And then you had the lockdowns in Europe. All that created a stagnant level of oil and commodity demand. Now, because with that seasonal coming back up again, that level is going to start shifting up. You have a macro tailwind, particularly with that, the non-farm payrolls number on Friday. You have lower rates, lower real rates, and a weaker dollar. So you have that tailwind going. And then you look at the fact that you have mobility rising. So we're likely to see the largest level shift on record for oil demand between now and July.
Yeah, I wonder also, Jeff, about 6 months ago, I moved from the suburbs to smack in the center of Berlin. I kind of made the opposite move that everyone else has. I've come to the middle of a city, and so I haven't driven at all compared to a lot previously. Most people, especially in America, are going the other way, right? They're moving from the big cities a little bit further out to the suburbs, maybe out to the country, and they're going to be driving a lot more. Is that a trend that's big enough for you to watch?
Actually, the bigger one is for people like yourselves. You're not going down into the subways, or the tubes. Like here in London, they're substituting rail and public transportation for the safety of their car. And that dynamic is bigger outside of the U.S. than it is in the U.S. Because you're absolutely right about the dynamic in the U.S., but it's amplified by what's going on more globally with the substitution away from public transportation to the safety and privacy of a individual vehicle. And you can even see it in, the auto sales, towards the end of last year. So the net of it is, really the part of demand that is hurting the most right now is the aviation fuel because people aren't flying.
We see this, all these price moves, and it makes me wonder what is it about the character, the nature of the commodities market that means you can't price in a demand shock ex ante? Why is that?
Well, first of all, these are assets that are what we call spot assets. Their price clears today's supply and demand. And when we think about an equity is an anticipatory asset. Its price is the accumulation of discounted earnings or dividends or something of that nature. So that's why we call equities and bonds anticipatory assets and commodity spot assets. Let's go to the core of what you're saying, is that ultimately, when you have tight markets, we get what we call backwardation. The spot price sits above the forward price. That tells you have a scarcity in the system. And when we think about, I like to say oxygen will be perfectly backwardated because you don't need it tomorrow. You need it today to stay alive. And so you're going to pay that premium to have it today versus tomorrow. When you have too much of a commodity, it's actually the opposite. Now, let's say we tried to price in a scarcity premium without scarcity. what it would do, it would attract any type of surplus oil or whatever commodity that was out there that would come into the market and crush that scarcity premium. That's why we say time spreads don't lie. If you have backwardated forward curves, it means you have really tight markets today, and more than half of the commodity markets are backwardated.
Yeah, very good point. Jeff, I want to pick back up on jet fuel, which you mentioned, because we have seen a pretty robust domestic air travel recovery. We've heard travel company after travel company talking about it in their earnings, but international travel is still lagging far behind. How difficult is the picture still for aviation fuel?
You're going to get a 1.5 million barrel per day boost somewhere around May 17th when Europe lifts that international travel boom, because ban. As a lot of that restriction is domestic, I like to say it, domestic European travel. So, flights between UK and Spain start to resume. That's going to have a significant impact on aviation fuel. Now, the big one I think that you're questioning is what is the outlook between Europe and the US, Europe and Asia? There's still big question marks around that. But the big one you're going to get the bump back in is when they lift that ban in Europe on international travel.
Earn free crypto just by learning about it. Coin